In asset costing and valuation, as the name suggests, we want to look at, first and foremost, all costs associated across the life cycle. So that really involves considering from design, construct, operate, maintain, dispose, and even beneath the line in terms of support, commercial, supply chain, etc. We want to be able to calculate the financial value of an asset from your respective asset or your accounting system, depending on where you are in the world. If you're an accrual-based system or an accrual part of the world, well, you'll be looking at the depreciable value of an asset versus those parts of the world that an asset is written off as a cost from day one. This also influenced decision-making around asset valuation. The third point here, looking at really the financial and the asset system being aligned, because finance really have a tendency to look at the value of an asset, where asset management is looking at the value from an asset. And as those two come together, you hope that they're aligned, but quite often one will outweigh the other one in terms of bias. And then finally, of course, when we've got the right information to support smarter, more effective investments, we can make decisions around the life cycle based equally around the context of our organisation, our stakeholders, and of course, the various asset classes that we have supporting our organisation. Data quality and integration are obviously an important factor in evaluating and, of course, tracking cost. But we do face the real risk that valuation data is inconsistent, it's incomplete, and how it's represented in the financial fixed asset register versus that of the asset management system will likely be different. We may have an asset management system that is a full-blown enterprise asset management system, or EAM. We might have just an asset register very much in Microsoft Excel to work with, or somewhere in between a defect management system. But what we really need to do by way of remedy is sit the teams down together, understand what the information is we require to make informed decisions, and have the finance and the operational/maintenance teams work together to define what the shared purposes are, processes are, but also what are the fit for purpose data standards that you wish to embed in your business. Everything from ISO 8000 all the way through to some of the more simple naming conventions, but without some rigor in data, your decision making will be flawed. To get transparency of cost, we first need visibility. And if we don't understand the basic premise between CapEx or capital for a new or bringing an asset up to its original condition versus OPEX, that being to keep an existing asset or plant alive, well, you're flawed from day one. What we need to do is train teams in understanding what TOTEX is, which is total expenditure. When you start talking about TOTEX, you immediately start to fall into the groove of supporting life cycle thinking, systems approach to your thinking. And of course, then we can work out, do we buy now, buy later, pay now, pay later? And it also gives us the opportunity to reflect on what an asset is actually costing us in the field after it's handed over from a project. So again, transparency of costs starts with visibility of costs. One very evident symptom of an organization is short-term thinking versus the longer term. Short-term often relates to the P&L, bonuses, that contract, that project. But the longer-term asset performance really forms effectively the balance sheet of the organization in terms of value. We need to really sit down with the different layers of the organization from top to bottom and across the life cycle, left to right, and facilitate a workshop that really appreciates what is the risk of these decisions that we're making. Is it a risk related to services or products of the organization? Is it a risk related to the assets that support those? What is the cost? And as we saw previously, TOTEX as a holistic view that separates the CapEx discussion and the OPEX discussion. And also look at where is the trade-offs in value. Because once we understand that, we start to shift to a mutual horizon that doesn't bias the short term or the long term. It starts to look at the horizon that's important to us in the context of our organization. When referring to cultural barriers, I'm talking about the context of the different subcultures of an organisation and very much via the various functions of an organisation. A finance-driven culture, as you can see, undervalues the non-financial benefits. They're looking very much at budget, reporting, appropriation, compliance, etc. But what we really need to do is back away from that and really start to look at what value actually is. Again, value of an asset from a finance perspective, value from an asset is the asset manager's perspective. Once we start to then focus on value, we start to help finance move away from just being a compliance and a controlling function to more of an assurance and a value add function. So again, cultural barriers from a change perspective in asset costing and valuation is really inviting finance to be a true partner in the sense of partnership, not just a reporting function. You may be lucky and live in a part of the world where regulatory legislation and accounting standards won't change for a long time. But when I've worked in different projects that have multi-currency, multi-jurisdictions in a global sense, it really is and can be a challenge in maintaining your accounting standards. So the risk here is, again, a new compliance or reporting standards surfaces, and then you've got to work out, well, how do you actually embed that, incorporate that, adopt that? So one of the ways around it is, of course, looking at those timely updates, looking at the change impact assessments and looking ahead for what the standards are that might change, and then create clear guidance for staff, especially involving finance and commercial, and actually playing it back, because if we're collecting information and data for one particular reason around cost, and under a new standard, we need more data or a different shape of data, moving people further into the discussion is only going to help you. Because so many times we see when there is a regulatory change around reporting standards, the business tends to react as opposed to respond, and it does get people disengaged and offside pretty quickly. There's nothing more shattering for an organisation when someone asks, how much is that asset worth? Or what's the latest cost? What's the forecast? How much have we spent of the budget? And you get multiple answers. The risk here, of course, is with poor costing, poor valuation processes, practices, etc., people will lose faith quickly. I found it very important, especially during a project build or an asset under construction, to really make sure your costs are known, understood. And likewise, out in operations, and in particular, maintenance, spare parts, hour consumption, etc. Being able to demonstrate that will also then remediate any loss of face, especially in front of an auditor and the regulator. So really engaging stakeholders, understanding the processes that you follow, making sure that people understand that the accuracy, even down at the coalface of doing maintenance, provides confidence all the way back up to the board and to external stakeholders, regulators, etc., is so important. And the demonstration of transparency starts with the demonstration of visibility. And then finally, how do you show improvements? So again, taking a plan, do, check, and act approach to the way you do costing and valuation will actually provide a lot more stakeholder confidence, but also provide you really real-time ability to answer the questions on where you are in your TOTEX. So if we take a look at asset costing and valuation as a parallel or alignment back to 55,001, the first thing that jumps out, of course, is section 6.2, which looks at our asset management objectives and how we plan to achieve them. Okay, so that's a real key one. The next one would also relate in the sense of operational planning and control, including life cycle management. During the international standard, we put a lot of emphasis on the life cycle management because it's not just vertically down through the organisation, it's across all the assets that support our service and product delivery. And then, of course, 8.2, control of change. Now, that is a key one, because if we do change anything from our asset base, a process, or even some of the regulatory standards we talked about in this module, we need to be able to demonstrate how we control that change, which really leads us to a later module in and around configuration management. So in summary, to simplify section 1.3 asset costing and valuation, all it's really trying to do is ensure that organisations know what assets really cost, what they are worth, and how this influences and supports decisions based around risk, performance, and of course, investment.